So yesterday, right at the end of this show, when the CP effect was fading, right, the market tumbled. I mean, it really, in a blink of an eye, the market shifted from cruise control into free fall, and the shock reverberated quickly, right? I mean, many folks raced to social media, looking to sound the alarm, also looking for answers. And soon, this was trending. Hashtag stock market crash. And well, in really many ways, it only made things worse. But I mean, there was a lot of questions out there, right? And here's the thing with the stock market and turbulence. We all know, I mean, we all been on planes and we're all used to turbulence and we kind of know what causes it. But let's admit it, when it happens, we're all a little bit nervous, right? So what caused yesterday's turbulence? Some say it was geopolitical headlines. Some say maybe a delay effect from FedEx. Remember that earnings report? By the way, that was the worst performing stock in the market yesterday. Others are placing blame on zero-day options. Remember, in the last year and a half, folks, I've been talking about these a whole lot. Zero-day options have really, to a degree, had an impact on this market, and some believe not necessarily in a good way. In fact, my panel coming up right now, they've got strong feelings about the Wall Street gimmicks in certain products. So I'm going to bring in Slaystone Wealth Chief Market Strategist Kenny Paul-Kari, and Rob Luna. He's from the head of Rob Luna Wealth Academy, founder and president. Kenny, let me start with you because you always say it's the algos, it's the algos. Well, what about these zero-day options? I mean, they're taking some toll on this market, aren't they?
Listen, they are, but there could have been 6 or 7 things you could have pointed at yesterday for that sudden turn in the market, whether it was the zero-day options, whether it was the FedEx and General Mills, whether it was Patty Harkin's comments, whether it was just the market being exhausted, whether it was just the algorithm scraping the headlines and finding some other negative headline, or whether it was, what's going on in the Mideast and the Red Sea and the Suez Canal and the oil supply disruption and the cargo disruption. Any one of those stories, you could have crafted a reason for the market to have backed off. I don't think you can pin any one of them, but the zero-day options, look, I'll be the first one to say, I don't trade options, so zero-day options, I'm not the right person to ask on how they may or may not have affected, but I don't think that alone could have been the answer to what we saw yesterday.
You know, Rob, I was here for the flash crash, and I'm still not sure what caused that. So, I mean, but it's unnerving, right? You can't be up, like almost a percentage point, then go down 1 percentage point in the blink of an eye.
Yeah, I mean, what it does, Charles, most importantly, as Kenny knows, it rattles confidence of the average investor. And that's the thing that worries me most. And the market has changed so much over the last 5-10 years with these algorithms, with these zero-day options, and that's more and more to come. But I think the most important thing as a long-term investor is you need to close your eyes, your ears to those days. You were talking to someone earlier, the stock market goes up over the long term. I would say use days like yesterday to be opportunistic. Unless you've got a 24-hour trading window, those are opportunities to buy when everybody's panicking. In the short run, you shouldn't be making long-term decisions.
All right, so Rob, let me stick with you on that, though. Today's bounce back, though, it's a pretty strong bounce back, and it feels good in some ways, but in other ways, it does heighten concerns over volatility. I know, listen, buy the dips, use these to your advantage, but when the market starts to get this extreme volatility, and we've been pretty comfortable with the VIX at 12, 13, even 11 handle, doesn't that change things for next year?
I mean, look, volatility, look, VIX at 12, Jim Uria was talking about if you're someone who's so inclined to hedge your portfolio with the options, you could do that. But again, I go back to the idea, Charles, look, there's going to be volatility. If you're going to invest in the stock market, be prepared at any time. The market could go down 10 to 15%. Don't put in money that you need to pay next month's rent with. Put in money that you're saving for 2 or 3 years. Volatility is actually your friend. Buy low, sell high is what we're all trying to do. So you actually need that volatility, Charles.
All right, so Kenny, let me go to you then, because it sounds like both of you guys are saying, put on your big boy pants and shut up. All right, we're going to do that. Now let's make some money. All right, both of you guys are long-term investors, and I love that about you. But from time to time, you find some fresher ideas. Kenny, let me start with you. You've got some ideas going into next year. Cisco, really, I was a little shocked about that one. Of course, we talked about this before, the utility play that should have been big this year. Utilities have been a disaster. What's the overall thought process for these ideas?
So listen, I think the Cisco is artificial intelligence, it's cybersecurity. I think it's underappreciated by the market. It's trading at a discount to its peers. It's certainly been in some pressure. There was in September we had the news about Splunk, right? That's going to give them actually additional exposure in the cybersecurity space. And so therefore, I think it's underappreciated by the market. Right. We saw it crack again in November when they had their earnings call, but now it's steadily making its way back. And I think it's going to continue. Once we get through resistance, I think Cisco's going to be one of those names that people are going to look back on and say, you know what, I missed this one, because I think there's more going on in the AI and cyberspace, and that's certainly going to be a focus in 2024 as well. So I think it's a place that you could put some money.
Speaking of AI, I know, Rob, you're saying that people who missed Amazon, Apple, and Google in 1998, they have a chance to sort of reap similar benefits with Web 3.0. We've only got a minute to go, but you say on the business side you like, and you've mentioned these names on the show before, CrowdStrike, Path, Shopify, Zoom, which is kind of intriguing, Coin, Roblox, and DraftKings. These have been extraordinarily volatile stocks. Explain, I mean, you're going to write, these are going to be some high beta, big ups and downs between now and 5 years.
Yeah, I'm going to take the other side. Like, Kenny's talking about value as Cisco, and I completely agree there. And there can be some 20, 30% upside in a name like that. But what I'm trying to talk about, Charles, is the big systemic plays of what you're going to do. I bought my best trade I've ever made was buying Amazon in 2000. I've sold very little since then. But, Charles, I've been down 90%, 50%. But it's not going to be Amazon, Google, Meta that's going to be leading the next 10 years. It's these types of names. There's going to be some volatility, so buckle up. But if you're looking for those 10 baggers, 20 baggers like we're all doing to pair with your S&P fund, these are the names that you have to go into. And I promise you, if you buy a basket of these names and you close your eyes, when you wake up in 5 years, you're going to see some really good returns.
All right, well, full disclosure, either I have them or my subscribers have 4 of these names, so I hope you're right. Kenny, Rob, you are 2 of the best. I wish we had more time. Merry Christmas, guys.
Thanks. You too, Charles.
Merry Christmas to you as well.
All right.